Hello and welcome back to the Mortgage and Protection Podcast. And this time we have Paul Holland here from Henchurch Lane to continue the conversation on self-employed mortgages. Great to chat with you as always, Paul. How's it all going?
Yes, very well. Thank you, Tessa. How are you? All right?
Good. I'm glad to hear that. And yes, all good too. Thank you for asking. So we've got three main sort of questions that we want to cover on this episode. So let's get straight into them then. The first one asks, what is the difference between interest-only and repayment self-employed mortgages?
Okay, so the key difference between the two is a repayment mortgage will be repaid over the term, and therefore at the end of the term the balance will be zero. So an interest-only mortgage would be the opposite. It would not be paid over the term and the balance would remain the same as you're only paying off the interest repayments each month, not the capital. So if you imagine a very sort of standard graph, if your mortgage balance is here and this is time, so I have to do this the other way around. Yeah, it's better this way, isn't it? Yeah.
Opposite,
okay, so
isn't it?
Time is here and your mortgage balance, time is this way and your mortgage balance is up here. If you pay interest only, your balance will just literally remain the same straight line all the way across the term. If you have a repayment mortgage, and over time you just have that nice downward curve, and it would result in zero at the end of the term of the mortgage. So that's the difference between the two, or the main difference. So because the lender is generally going to be asking for the loan to be repaid, either throughout the term or at the end of the term, then an interest only, where you're not paying that down, usually wouldn't be used for your main residential home. Okay, so it's going to basically leave you in a position where you'll need to sell your home at the end of the term to pay the mortgage back, which might not be ideal because you need somewhere to live, or you'll need something in the background like some sort of endowment or a repayment strategy, let's say. The reason that people are more likely to go down the interest-only route is generally for buy-to-let properties, where you'd have an income coming in from the rental throughout the term, and then at the end of the term you can sell that, obviously pay the mortgage off and cash in on any kind of appreciation that you've earned over the term as well. So that's normally the setup. You can get interest-only options on your main residential home, but they're generally going to come with certain types of criteria that you'll have to meet, and usually a combination of certain things. So as an example, there could be a minimum equity requirement. So they might ask for, let's say, a current equity amount of £200,000. They might ask for a minimum income requirement. So let's say the two of you living there would need to earn a minimum of £100,000 towards the application to hit that criteria. And they might also put some sort of restriction with the loan to value in there as well. So they might say you can borrow up to 50% of the value of the property on an interest-only mortgage. And generally speaking, they're all different, but generally speaking, you're going to have a combination of those three things to hit in order to basically be signed off as okay on the interest-only application.
Okay, well, some clear differences there and a great demo. Great demonstration. So hopefully that's helped everybody out. Backwards, yeah. Okay, so the next question we have here then asks, what are the minimum mortgage requirements for self-employed people?
Okay, so a little bit more arduous than it would be for employed people, which is why it's just a little bit more specialist and worth putting the legwork in beforehand. So document-wise, an underwriter is always going to ask self-employed people for a specific set of documents that, like I say, is going to be a little bit more long-winded than your PAYE people. So if you own more than 20%, or in some cases 25%, so the shares in the business, 20 or 25%, depending on what lender. If you own more than that, then effectively you'll be viewed as self-employed. Okay, so a lot of people think because they're employed as a director or have a PAYE payslip as a director that they're employed. They're not. If you own those amount of shares, then generally you're going to be looked at as a self-employed person. So under that, you're going to be looking at a list as follows. Okay, so you're going to need at least your latest 2 years worth of SA 302s, also known as tax calculations. The only instance where that would differ is if you've only been trading for 1 year. So in some cases, you could approach a lender with 1 year's accounts. And obviously, you would only need 1 year's because that's all you've got. You would need the corresponding tax year overview documents from HMRC. If you do these submissions yourself, you can get them on the portal. If you use an accountant, generally they'll have them. You're going to need 3 months, latest 3 months worth of bank statements showing your income going in, ID and address proof, whichever you'll need. So, passport, driving license, proof of deposit, again, which most people will need. Generally speaking, you're looking at a minimum of 5%. There are alternatives to that, but the rule of thumb is a minimum 5%, whether that's cash or whether it is equity in your property. If you're a director of a limited company, then you can add to that as well. So they're going to need the latest 2 years worth of company accounts, and likewise, again, if you've been trading for 1 year, just the latest year, and also the latest 3 months business bank statements as well. So it's almost double the amount of kind of paperwork you'd need in comparison to someone that's on a PAYE basis.
Okay, so hopefully everyone was listing those down, writing them down. But of course you can listen to this back. Yeah, definitely. Okay, so just lastly then, what if someone's income has dropped significantly in the past year? And I think you've got a case study as well to use.
Yeah, absolutely. Threw one in there for you. So this is a really poignant point at the moment just because of the times that we're in, and we're experiencing it quite a lot as well. So definitely worth touching on, and like I say, case study in this instance was really easy because we've got lots of them. But as a self-employed person, there's lots of reasons why your income could have dropped since you last did your mortgage, or even just in general. If you're a first-time buyer, there's the reasons are the same. It may not actually be less, but according to the underwriter, the way that they review or assess those figures and the times where you post your income, it could appear to them that actually your income has gone down. So, it's important that we understand the ways in which we approach that. In reality, you could be earning more, but if the documentation isn't there yet to back it up, it doesn't really matter from a lender's point of view. So yeah, it's worth bearing in mind. Of course, you could have actually earned less as a result of obvious factors like, COVID, for argument's sake. That's a big one. The market conditions that we're in at the moment. You could have chosen specifically to work less and other reasons. So, like I say, if an underwriter determines that there is a downward trend for whatever reason, then they're likely to use that figure, the lower figure, even if your previous year was higher. So it's worth bearing in mind. It's only really going to be an issue if you're looking for a new mortgage, so you're looking to remortgage elsewhere, or you're looking to borrow more than you already have with your existing lender. So if that is the case, then the approach that we take is to run figures based on what we have at the moment, but also we can run it on a hypothetical basis because a lot of the times people's incomes can also be on the up. Next time they submit their accounts, some of that would have been recovered. So if it makes sense for us to say push the application to the next set of accounts or give you some advice around the timings of that, then we're gonna look to give you those kind of hypotheticals or projections as well, right? But if you're not looking to borrow more, it's not as much of an issue. So the example that we can give you is the case study we discussed. We have someone that we've recently done business with. Their business was impacted quite hard by COVID, and their latest set of accounts were quite a fair bit less than when we arranged their mortgage 2 years ago. So their fixed deal was coming to an end. It was around about 5 months out, which is when we'll start to look at it, 5 or 6 months out. And we sat down with them. Their mortgage repayments would have increased by about £950 if they fell into the standard variable rate. So if they did nothing, which some people might have thought was their only option because their income's gone down, then a £950 increase per month, which obviously, as you can imagine, is quite a steep increase.
Yes, yeah.
So because their income had dropped for the latest year, we said to them, we still have options with your existing lender, which they weren't aware of, something called a product switch. And we approached their existing lender and secured them a new fixed rate, which worked out at sounds bad, £500 increase, which isn't great. No one paying less on their mortgage than they were in their last fixed rate at the moment, but it's obviously quite a stark difference between 950 pounds a month. So still an increase, but a huge difference. So it's a big takeaway. If you've got a mortgage, self-employed, and your income has dropped over the last couple of years, don't think that you have no options. You can still secure a fixed rate with your existing lender without having to let yourself fall into that much more expensive standard variable rate. So that's the sort of biggest takeaway at the moment. A lot of people are aware of the product switch options, but there are plenty of people we've spoken to that aren't. So get in touch with your broker, get in touch with us. We're happily review the figures and tell you what your options are with your existing lender, because some lenders don't actually approach you personally and make you aware of them, which is quite an issue at the moment.
Okay, well, hopefully that sounds reassuring to anybody watching this. Hopefully we've helped a few people out. I know we're going to be back with some more questions for the self-employed, aren't we? So we've got more to cover soon. But yeah, thank you for that as always, Paul. And we'll speak to you again soon.
You're very welcome, Tess. I look forward to it.